Most people grow up believing that money is something scarce and concrete, that it begins its life as coins, paper, or numbers already sitting somewhere, patiently waiting to be earned, saved, or spent. Yet one of the most uncomfortable truths of the modern world is that almost all the money you will ever touch, swipe, or see in your bank account did not exist before a bank decided to create it. Not by printing anything, not by moving someone else's savings, but by typing numbers into existence, a process so routine that it powers everyday life while remaining deeply misunderstood. Because if this mechanism were explained honestly and slowly, it would force people to confront the unsettling reality that modern economies are not built on physical wealth, but on promises layered upon promises, and that stability itself is a psychological achievement rather than a natural condition. To understand how banks create money out of thin air, it helps to begin far from skyscrapers and data centers, in a time when money was heavy, visible, and slow, when gold and silver coins defined value, and economic activity was constrained by the difficulty of moving metal across distance, making large-scale trade risky and expensive, which meant economic growth was limited not by ambition, but by logistics. And it was precisely this friction that encouraged people to search for substitutes that could move faster than metal without losing trust. In medieval Europe, goldsmiths became early custodians of wealth, storing precious metals in vaults and issuing paper receipts as proof of deposit. And these receipts soon began circulating as money themselves, because it was easier to exchange a trusted promise than to transport gold, marking a critical psychological shift where value detached from physical substance and became portable through belief. Over time, goldsmiths noticed something quietly transformative. Depositors rarely came to reclaim all their gold at once, which meant much of the metal sat idle, economically useless. And from this observation emerged a powerful incentive to issue more receipts than gold held, lending out promises against reserves that would likely never be fully claimed simultaneously, not as an act of fraud, but as an efficiency gain, because unused wealth could now be activated through credit. This was the birth of fractional reserve banking, a system built not on certainty but on probability, where trust and statistical regularity replaced physical backing as the foundation of money. And once this logic was accepted, there was no natural limit to expansion except confidence itself. As banking evolved and became formalized, states stepped in to regulate and legitimize these practices. Recognizing that credit creation was essential for economic development because large projects from infrastructure to industry required capital far beyond what accumulated savings alone could provide, and banks became the intermediaries that transformed future expectations into present spending power. The crucial misunderstanding that persists today is the belief that banks merely lend out existing deposits, acting as passive middlemen between savers and borrowers, when in reality, modern banks create new money whenever they issue a loan, because the loan itself becomes a deposit, instantly expanding the money supply without reducing anyone else's balance, a mechanism confirmed repeatedly by central banks and financial institutions, but rarely explained clearly to the public. When a bank approves a mortgage, it does not transfer money from another customer's account. It credits the borrower's account with new funds, simultaneously recording a loan asset on its balance sheet. And in that moment, money is created, spendable and real in every practical sense, even though it did not exist the second before. This process feels like magic because it violates intuitive assumptions about conservation, yet it works because money is not a physical object, but a social technology, a system of accounting that coordinates trust and obligation across time. The only real constraint on this creation is not reserves in a vault, but regulatory capital, perceived risk, and the bank's confidence that the borrower will repay, meaning money supply expands or contracts according to collective optimism and fear rather than physical scarcity. Central banks sit above this system not as direct creators of everyday money, but as architects of incentives, influencing interest rates, liquidity, and risk tolerance, guiding but not commanding the flow of credit. And this distinction matters because it reveals why money creation accelerates during booms and collapses during crises, amplifying economic cycles rather than smoothing them. In periods of optimism, rising asset prices reassure lenders, making loans appear safe, encouraging banks to create more money, which fuels further price increases, reinforcing belief in a self-validating loop. While in downturns, this same mechanism reverses, as fear tightens lending, defaults destroy deposits, and money effectively disappears as debts are written off, leaving behind the sensation that wealth has evaporated. This dynamic has repeated throughout modern history, from 19th century banking panics to the Great Depression, from post-war credit expansions to the global financial crisis, each episode revealing that money is not a stable backdrop, but an active force shaped by human psychology. The phrase "out of thin air" captures the shock people feel when they first encounter this reality, yet the air is not empty. It is filled with laws, institutions, expectations, and social norms that give those numbers meaning. And when those supports weaken, the illusion of solidity collapses with devastating speed. Bank runs offer the clearest demonstration of this fragility, because when depositors lose confidence and demand their money simultaneously, the system's probabilistic foundation is exposed, forcing governments and central banks to intervene, not to protect banks alone, but to preserve the shared belief that money will be there tomorrow. Deposit insurance, lender of last resort facilities, and emergency liquidity programs are all psychological tools as much as financial ones, designed to prevent panic from turning mathematical possibility into social catastrophe. Yet, these safeguards introduce moral hazard, because if banks expect rescue during failure, they may take greater risks during expansion, knowing losses can be socialized, a tension that has haunted financial regulation for decades and remains unresolved. The deeper question is why societies tolerate such a system despite its obvious dangers, and the answer lies in the trade-off between stability and growth, because a money system tied strictly to physical assets limits economic expansion, while a credit-based system unlocks immense productive capacity at the cost of periodic instability. Modern prosperity, from mass home ownership to global trade networks, is inseparable from the ability of banks to create money through lending. Yet so are inequality, asset bubbles, and debt crises, because access to credit determines who benefits most from money creation. Those closest to the banking system, often large corporations and asset holders, receive new money first, allowing them to buy before prices adjust, while wages and savings lag behind, redistributing wealth subtly but persistently, a phenomenon economists have debated for generations without consensus. This distributional effect underscores that money creation is not neutral, even when it is legal and routine, because it shapes incentives and outcomes in ways that extend far beyond accounting. At a psychological level, debt-based money binds the future to the present, because every loan represents a claim on tomorrow's labor, and interest ensures that more must be produced later than exists now, embedding a growth imperative into the system itself. This helps explain why economies struggle with stagnation, why policymakers fear deflation, and why crises provoke such aggressive interventions. Because without expansion, the system's internal logic strains under its own obligations. Attempts to restrain money creation through tighter regulation or higher interest rates often collide with political pressure, because credit fuels employment, consumption, and social stability in the short term, even as it increases vulnerability in the long term, creating a cycle where caution is punished and risk rewarded until collapse forces a reset. Over time, this pattern normalizes extraordinary measures, making emergency policies permanent features, blurring the line between market discipline and state support, and reinforcing the perception that money is both endlessly available and perpetually fragile. The rise of digital banking and electronic payments has further abstracted money from physical reality, making creation even less visible, as balances change with keystrokes and algorithms assess risk faster than human judgment ever could, accelerating cycles that once took years into months or weeks. Despite this complexity, the core mechanism remains unchanged. Banks create money by expanding credit, constrained not by vaults but by belief, regulation, and collective emotion. And when those constraints loosen, money flows freely, When they tighten, it vanishes just as quietly. Understanding this does not require viewing banks as villains or heroes, because they operate within a system that reflects societal priorities, rewarding growth, convenience, and optimism, while underestimating fragility and long-term risk. The unsettling realization, once the process is fully grasped, is that money's power comes not from what it is, but from what people expect it to do. And that expectation is managed, nudged, and sometimes distorted by institutions whose decisions shape lives far beyond boardrooms. When banks create money, they are not breaking rules or performing alchemy. They are translating trust into numbers that guide behavior on a massive scale. And as long as societies rely on this translation to organize economic life, money will continue to appear from nowhere, expand and contract with confidence, and remind us, often painfully, that the foundation of modern wealth is not physical scarcity, but shared belief. A belief that feels permanent during calm periods and terrifyingly fragile during crises, leaving us with the lingering, quiet discomfort that the most powerful force in the global economy is not any single institution or policy, but the collective agreement to accept numbers created today as promises that tomorrow will somehow make them real.